So you want to learn how to do a vendor take-back mortgage? I'll show you in this video, first of all, what it is, how to structure it, and some of the pros and cons of using vendor take-back mortgages.
Look, I get it. The Toronto real estate market is confusing. Whether you're a new or experienced investor or just looking for a home to raise your family in, join us at Broadview Table Talks as you sit around the table with my friends to talk about the real estate and the ever-changing market in Toronto.
Hey guys, Kenneth here. So, we're in March 2023. It's a very turbulent time for the real estate market due to the interest rate hikes, as you know. And everyone's just trying to get a little creative on how to structure a deal. And one of them is using a vendor take-back mortgage, which is commonly referred to as a VTB, or really just seller financing. So essentially, how to structure it, I'm getting a lot of realtors in the office. Actually, let's explain what it is, first of all. Vendor take-back mortgage is the seller giving you the mortgage in place instead of a bank, right? So if the seller has a property, whether it's commercial or residential, more commonly it's in the commercial world, but now it's happening we're starting to see it in the residential world. So the seller has a property that's completely paid off. There's no mortgage on it. That's the simplest case. They've owned it for 20 or 30 years. They don't want all their money up front, right? Or maybe just sell the property at maybe they're just tired of the repairs. They're just tired of owning a home. They're tired of the headaches that come with it, and they want to sell it and take that lump sum and move, right? So what you would do is you'd have the seller give you the mortgage at a prescribed rate. It's meant to be used as short-term financing. It's not long-term. It's not like a mortgage where you pay off in 25 or 30 years. You're looking just to kind of get over the current hump of qualification that's happening right now. So what the seller would do is you're going to use a seller take-back mortgage, simple interest only. That's mortgage 16, MORT-16 in web forms. There's MORT-14, which also includes principal repayment. But for the simplest case, we're going to do interest only. And all it says is that the seller agrees to take back a first mortgage or second mortgage for the balance of the purchase price in the amount of X amount, bearing the interest rate of whatever, repayable and interest only payments, and the first of the month starting on whatever, right? Then the lawyer will finish off the standard charge terms. There's a lot of other details in the case of like what happens in the case of defaults or how many terms they can renew it, when the sellers can call the loan, for example. Anyway, just the simple clause for your agreement of purchase and sales would be using the MORT-16 and maybe the MORT-27, which is the renewal terms. Hopefully that I didn't lose you there. But essentially, why you'd want to do it, how you can do that, well, you're going to be looking for some advantages for that. The seller, if they have in Canada anyway, they have up to 5 years to claim the income payment. So if you're spreading, let's say they're making $2 million, right? Then basically you do 4 years of earning $400,000. And that might be advantageous for you if you don't want to pay the capital gains taxes in one shot and you can do it over a spread over 5 years. That might be possible. Or maybe so that the seller can get some interest on their payments, right? So right now you're getting first mortgages through a bank at around 6%, 5% maybe. If it's a commercial loan, you're looking at 7s, maybe even 8%. And if you don't qualify for those loans, you're going to go to the secondary market, second banks, and you're going to get 9%, 10%. That's like pretty high, some even 12%. So why would the seller want to do seller financing? Well, if they have a lot of equity in their property and, take that lump sum after capital gains, taxes and all that, where else are you going to put it? Where are you going to put that money? Aside from the capital gains portion of it, in the current bond market, you're going to get 5% at most? Open a high interest savings account, you might get 4%. Whereas if you structure a deal and you get 7% on it, on $2 million, that's 140 grand a year, right? That's pretty good. And if you divide that out by a month, you're going to get just over $11,000 a month in interest-only payments. And the best part is, after that term is over, whatever you structure with a buyer, you're going to get that money back in terms of the principal back, the original agreed payment, the $2 million that you agreed to. And on top of that, you get $11,666 per month until that term is up. So that's a good thing for the borrower. The good thing about that also is that you don't have to go through the qualifications, the strict qualifications that you would normally would at a bank. Show me income, show me, drop your pants and show me everything, bend over, touch your toes. That's what's happening nowadays with mortgage qualifications because lending is really hard to get. So that's great. And then also you have potentially lower costs too. Like I was saying, if you don't qualify for A banks, you might have to pay like a 9% for a private or 12%. Seller financing might not be a bad thing. Now, the downside though of this is that you have a couple things here. There's higher risk, you have lack of flexibility, and potential conflict. What I mean by that? Well, a higher risk means that what happens if the buyer defaults on the loan, right? Then you have to take that property back as a seller and you have to go liquidate it or sell it again. It might be in your favor, it might not be in your favor. If the market goes up, it might be in your favor. If it goes down, then you got to go sue the buyer for that money. And chances are, if they're borrowing a VTB, then they might have done it through a corporation. You might have to actually ask for personal guarantees, which is great, but maybe they don't have good credit anyway. It's hard to claim back from them, right? So there's a bit of higher risk. And then you got lack of flexibility. So lack of flexibility means that the rates might be a little bit higher than you would get at a traditional bank. The term, they might only give you a 1-year term or maybe a 5-year term, which is great too, but you can't amortize it. maybe you want that. Maybe you want to have some credit with a bank. There's a whole bunch of things that are just not as easy to look at if you're just negotiating directly with the seller. And then you also have the potential for a conflict. So what happens if you don't agree with a seller and you guys get into some sort of argument? I mean, for when it talks to money, you talk about commercial, it's not so personal, it's just more of a deal, right? But what happens if you miss the payment, right? There's some potential of a conflict there, especially if there's disagreement in the terms of the loan, and come closing, you don't want that issue to happen. Another thing that you might want to consider about why you'd want to use a vendor take-back mortgage, first of all, again, I said in the beginning, it's not a long-term solution. You're only using it for short-term to get traditional financing in place, your takeout financing, as you call it, right? So you're gonna look for the best rates from an A bank if you can qualify for that, and do it long-term. So maybe you want a vendor take back to do short-term repairs, if you're going to increase the rent roll, if you're going to make repairs to the place and then all of a sudden it has a higher valuation, and then you're going to borrow more money to use your takeout financing at lower rates, but borrow more money and you make the same payments. So that's another great strategy on using better take back mortgages and why you'd want to do it.
Add it up.
Thanks for sticking out to the very end. I hope you got some value out of this. Do me a favor, please press like and subscribe, but more than anything, leave me some feedback so we know what to produce for you going forward. Thanks again.